Hello, fellow investors. I can't help but notice this sell-off that happened last trading hours was kind of what can be perceived to be caused by the indiscriminate selling of consumer cyclical and consumer defensive sectors. In my opinion, this was first seen with Amazon, a kind of a hint for the whole sector. So in this video, I'll be looking into their earnings, specifically the earnings of Amazon, Walmart, HD, Low, Target, and Cost. Are they really terrible? I'm sorry guys, but I'm in the middle of screening restaurant stocks right now, so in this video I won't be giving you my price targets for the stocks yet. Maybe next week when I'm done with restaurants, I'll screen stores stocks. For now, I'm only looking at their earnings report, the revenues, the margins, the EPS they put out for this quarter. First is Amazon. The last time I screened this stock, it was around 2,900, and I told you it's overvalued, don't buy. This was a growth stock with high growth multiples and high growth expectations, like a Netflix. The stock is now down to 2,100. I saved you $800 per share if you didn't buy the stock. No matter how many videos this guy puts out about Amazon to try to defend its valuation, it's not gonna work because it's not worth that much at the moment at the current market situation. Anyway, if you love listening to these kinds of people, you are bound to lose a lot of money, and maybe you deserve losing that money. This is Amazon earnings snapshot. They reported last April 28, 2022 after hours. You can see here very clearly it was a very bad quarter for Amazon. Revenues are up 7%, but again, no one buys on the basis of PS ratio, don't get fooled. Look at those margins and EPS. 8% down EPS year over year. Net income 147% down. Free cash flow 125% down. Their margins for this quarter are even lower year over year. Negative 3%, negative 15%. This Amazon earnings was kind of a warning to the whole sector. This was a bad earnings report for Amazon this quarter. Next is Walmart. Walmart reported last May 17, pre-market. It's the same with Amazon. Revenues are up 2.4%, but look at the net income, look at the free cash flow, look at their margins. Net income down 25%. Free cash flow down almost 1,000%. It was a bad quarter for Walmart as well. Next is HD, Home Depot. Home Depot reported May 17, pre-market. Their earnings were bad actually if you look at the free cash flow. Down 47% year over year. Their margins are lower year over year as well. Profit margin down from 11% to 10%. Free cash flow down 8%. Well, HD's earnings were not as terrible compared to Amazon and Walmart though. Lowe's revenues are down 3%. Net income and free cash flow were terrible as well. Free cash flow is down 35% and their free cash flow margin is down 5%. Bad quarter, but not entirely bad like an Amazon and a Walmart, but it's a bad quarter still. Target, same story. Net income down 52%. Free cash flow down 500%. Very bad quarter for Target. Their margins for this quarter down 4%. Net income. Free cash flow margins negative 9%. It's a very bad quarter for Target. Actually, cost stock was the best among the sector, but they reported what? But Costco reported last March, 2 months ago almost. Here are my thoughts about the sell-off. Basically, they were all overvalued anyway. I think this is not just because they reported bad quarter. I think this is also a multiple compression. some stop losses got haunted, and institutions just liquidated their positions. Mainly because of the Fed's doing, and cash really is king right now. Then why did Buffett buy stocks? Remember, always is the best time to buy stocks. It's just a matter of what stocks you're buying. Whether you're buying overvalued stocks or in the Buffett way, they bought low PE stocks, undervalued stocks. I think this cycle of indiscriminate selling was kind of expected. It happened first with tech, then most growth stocks, now the overvalued ones. To tell you honestly, I think there's more air to be popped. Mostly the dividend growth stocks, the dividend bubble I told you about. Unprofitable companies with almost 20, 30, 40 billions in valuations are likely to go down more. Still, guys, here's my advice: buy undervalued dividend stocks and you win the stock market. Buffett style, my style, always with the dividends.